In this video, I conduct a special interview with mortgage originator John Edmead of Homespire Mortgage, where we talk all things lending to better prepare you for the home financing process. All right, so we are recording. I'm here today. Again, I am Chuck Burt. I am a realtor in the Central Florida area. I'm here today with John Edmead. I'm very happy, to have him as a guest. We're going to be doing an interview today, all things lending. If you are considering financing a mortgage now or in the near future, this is the interview to watch. John is an amazing mortgage originator. I use him on numerous transactions that I've completed with many of my clients. He's amazing at what he does. He's an amazing guy. I know him personally. Really cool dude. A wealth of information when it comes to the lending world, which is why I asked him to be here today. So really the intention of this video is to take you from A to Z with the lending process, how to get started, how to choose the right lender for you, and then through the pre-approval process, while you're going through it, underwriting process through getting a mortgage, and even after you close on your home, kind of what you should expect. So we're going to grill John. I've prepared a number of different questions for him today. But before we get started, I'm just going to flip it over to him just to allow him to introduce himself. Go ahead, John.
Chuck, thank you. And what an awesome. I'm humbled at the kind words you've said about me. So I do appreciate them, and I enjoy working with you. You're super sharp. You're great at what you do. Your clients love you and rave about you. So it's an honor and it's a pleasure to handle the transactions that you've trusted me with. My name is John Edmead. I work with Homespire Mortgage, Central Florida area manager for Homespire. This is my 23rd year in the mortgage industry. It's crazy to think that, I'm 46, so that's 23 years, half my time on earth. We've been writing loans. Love what I do. Very passionate about helping folks, succeed in whether it's purchasing a home, building a property, a house, or just perhaps even looking at their overall debts and accommodating their debt structure, via the equity that they have in their home and just leveraging at a lower rate so they can save some monthly income, every month. Originally, born and raised in Maryland. My parents are both from the Dominican Republic, so they immigrated to the United States like way back in the late 60s, 70s. And I ended up in Florida actually. Graduated from high school. I went to high school overseas in the Dominican Republic with school at the University of Florida, and I ventured back to DC and moved into Orlando in February of 1997, and became a mortgage broker in November of that same year. And it's been a great market to be in. Very, very proud and happy to be a participating member in the Central Florida community. Father of 3 kids, and 2 of them are in high school. God's got a funny sense of humor with things that apply to my life. So I've got a 3-year-old as well, JR, and deeply young, and I love chasing all 3 of them around, and I'm into pretty much whatever they're doing. So outside of mortgage life, kids, is pretty much where it's at. And of course, the benefits of living in Central Florida. You go to the beach, you get to go boating, you get to go fishing, you get to go out and check out some really cool spots. So good things.
Great. Well, again, John, we appreciate you, coming on and doing this interview. I hope everyone is going to get a lot out of it. Really, again, the point is to educate everyone on how to make the best decisions in regards to lending, so you can achieve amazing results with whatever your real estate goals are. So we'll jump right into the interview. And to kick things off, and this is kind of a general question in regards to how to choose the right lender. John, maybe you can talk about the differences between, dealing with a big bank lender, direct lender, maybe a smaller, more local lender, and what a mortgage broker is. You can talk about the differences, what some of the advantages and disadvantages are of using the different types of lenders.
Sure. Great question. I get that question often. There's, at the end of the day, the ultimate end product, which is the mortgage itself. Anybody that is in the industry that produces those home loans, whether it's a USDA loan, FHA loan, VA loan, conventional loan, terminology called jumbo mortgages, we all operate and play by the same rules set forth by names like Fannie Mae, FHA, or HUD, Freddie Mac. And so realistically, there are some differences. Banks are banks, and everybody in their mindset, I think, typically thinks anything related to financial services, let me start at my bank. And oftentimes that's great. What I have found over the years in my experience with lending, and I've worked at, in my career span, I've worked at small companies, I've had my own company, I've worked for big banks, I've worked for, independent mortgage bankers, which is what Homespire Mortgage is. I've been a mortgage broker before as well. And so first thing is this: the person who is going to help you with your mortgage, they should be readily available to you. They should take a consultative approach to the business. Mortgages are not one size fits all. Chuck, a lot of people think that I'm in the business of doing home loans, and I really don't see it that way. I see that my primary objective is learning more about my client and identifying, what's important to them. So in other words, what are their long-term goals and what are their short-term goals, right? And how is this mortgage going to, in essence, fit for whatever their plans are, whether that's a payment objective, an equity objective. But and before I can do that, right, I have to understand what's important to them about that home loan. So that's typically where I start, my questions with the client. Because again, a lot of times you might go to a bank, the person who you call at the bank, they're just there to, perhaps open checking accounts. They may not have the depth of mortgage knowledge. So they'll transfer you to the mortgage department. You'll talk to someone who's there. Hopefully they're able to take a phone call. In the mortgage industry today, realistically, you have banks, which would say would be the top. Then you have independent mortgage bankers, which have a number of them out there. You'll hear tons of companies. I could rifle up a few names, but for the sake of keeping our interview in time, consistent with what we're speaking of, I'll leave that as independent mortgage bankers. And then below that, you would have your first tier, of financial service provider when it comes to mortgage, and that's the mortgage broker. So the inherent differences between those three: the mortgage broker, in essence, is there. They are going to, in essence, connect the need with the source. So they're a middle person, and they're paid for their services, and well so, because they do help clients. There's a huge percentage of home loans that are closed by mortgage brokers, and realistically, they tend to have a little bit more of a diversity of what they can find than your bank. Your bank says we're only going to do these types of products because we're not in the industry or in the interest, because they're a bank and they have shareholders, to do all of them. So they're pretty specific to a few, typically, what we would say in the mortgage industry, vanilla, right? Easy stuff, good credit, make sure that you've got all your documentation, perfect borrowers, if you will, if that even exists. That's, where mindset is going to go. That independent mortgage banker, they are the ones that they have in their office, under their roof, where they operate. They control all of the functions only just for mortgages. So a mortgage banker versus a mortgage broker versus your banker. Your banker can help you with auto loans, credit cards, home equity loans, anything related to banking, checking accounts, etc. I don't do any of that stuff. I am basically home mortgages. So, and similar to a bank, at Homespire, we underwrite, we process, we close, we fund, we service, all within all within our Homespire family. A mortgage broker is primarily just an origination, right? They're just there to help you procure, secure, and close on your home loan. They don't typically employ underwriters. They don't typically have a closing department. They typically will not have a funding department, and they do not service mortgage loans. They're going to, in essence, connect your need or application with a lender, maybe perhaps someone like myself, maybe perhaps someone like a Bank of America, Chase, Wells Fargo, etc. I hope that made that clear.
Sure. Fair enough. So to follow up with that question, John, if you were to recommend, for someone who's looking to finance, a home purchase in the near future, as far as getting the best deal and who to work with, in your opinion, and I understand you're a little biased, who would you recommend would be the best option for folks out there trying to get, the best deal?
I would say that it's important to ask questions. Your mortgage professional should be able to tell you why your interest rate that they've quoted you is the interest rate that they're quoting you. In other words, there's a number of things that goes into quoting an interest rate. And an interest rate, unlike what some folks consider what they get on their computer, they see a rate that's advertised and they think that that's everybody's interest rate. And sadly, that's just not the case. There's a lot of fine print that goes to those, when you see an interest rate that's advertised, you just want to make sure that you check what else goes with it. And so, since we're speaking to consumers, folks that are thinking about buying a house, I will tell you this. You can online, you can go FreddieMac.com, FreddieMac.com. Freddie Mac, their landing page, every week they have a mortgage rate survey. It's a national survey that tells you across the country what the average rate in America is on a 30-year fixed rate mortgage that's conventional and a 15-year fixed rate mortgage that's conventional. I would say that as a consumer, if since the world is so small, thank you for the internet, knowledge is power, and you can take the time to, without overdoing it, right? You can take the time to at least get a little bit of a general background on what you're about to begin, right? So average rates are X, Y, Z. Okay, great. I should be able to talk to someone that can help me understand what goes into the interest rate, things like credit score, things like loan amount, things like loan type, things like debt to income ratio. And like anything, I think that folks are going to have a different level of comfort working with different people. And so that's really what it boils down to. If someone conveys trust, they hold integrity, they honor their commitments to you when they start to talk to you. You can check them out on social media, surveys, et cetera, to see what the world has to say about them. I think outside of that, really, it's kind of like in our situation, Chuck. There's a triangle for trust, is what I call it. The clients that you refer to me, they have instant accountability and credibility because you hold me accountable. If I, for any reason, don't take great care of those clients, the first person they're going to tell is you. The last person who's going to call me again, more than likely, is going to be you. So there's a big deal when it comes to having a relationship with a real estate professional, with a lending professional, or in any other matter. If you're going to go get your car fixed, if you're going to get your teeth pulled, you wouldn't just go to the mechanic to get a toothache. You want to make sure that you're going to someone, who's a specialist and who's skilled and takes great care of people and has a great business reputation with regards to what they've done in their career, right? So so you always want to check that out. That's my biggest thing.
All right, well said, John. So next question, John, and this is in regard to kind of get the process started. After you've kind of made a decision and you've talked to a few different people and you picked out a lender, regarding the pre-approval process, maybe you can speak to that a little bit. How long does the pre-approval process take? What goes into it? What documents are required on your end from the client in order to give them a determination? Maybe you could just speak to the pre-approval process a little bit.
Sure. Yeah, and that's I'm going to answer that with a little bit of a technical flair because there's in our industry we've got tons of regulation, tons of compliance, things that we all have to abide by in the mortgage space. And so there's a term called the pre-qualification, and there's a term called the pre-approval. And understand that there's also some regulatory agencies that control and regulate what lenders do, right? So with that in mind, pre-qualification is typically a verbal conversation that's had between a consumer and a mortgage professional. There is in that environment of a pre-qualification, there may be an exchange of information verbally, but there is no exchange of documentation to validate that information. Hence, a pre-qualification, in essence, it is an opinion without verification or validation of a borrower or a consumer's capacity to lend, to borrow, to purchase. Whereas with a pre-approval, far more in depth, there's a lot more due diligence that's done, on the part of the lender. And so for the purposes of the rest of this, I'm just going to talk about pre-approval because if you're only interested in a pre-qualification, folks, ladies and gentlemen, you can do that yourself. Go on Google, find a mortgage calculator. You put in how much money you make. You put in how much money you spend every month, and it's going to say, well, you can qualify for roundabouts this much mortgage payment. It hasn't checked your credit. It hasn't run that loan through an automated underwriting system. It's not really pricing that loan to market. Okay. It's just it's a feel good. Hey, we can do this. Great. But what you also need to understand is that, you know, with regards to credit, the world is so wide open these days, and it's a great conversation I have oftentimes. Folks, I will share with you this. You may have Credit Karma. You may have one of your credit card companies that monitors your credit. And every month, just like I do, it tells you how awesome your credit score is. Please understand that those are consumer credit reporting models. They are not the same models that any residential mortgage lender uses. When you look at a consumer credit report, hey, you know what? Your credit score, feel great about it, okay? If you're on the market for a credit card, if you're on the market for an auto loan, those are great references for you to use with regards to where your credit score is. But when it comes time to purchasing a home, every lender looks at a residential mortgage credit report scoring model. It's the most, I'd say it's probably the strictest, and it's just the one that's the newest of all of the models that are put out by Equifax, Experian, and TransUnion, your bureaus. And so there's always going to be a variance between what your consumer score is and when you sit down with your lender. You know, you might see a swing where it could be 10 points, 20 points, or more lower than what you might think. So to that effect, do your homework early. Everybody should still remember that you can get an annual credit report for free every year. No, it's not going to tell you your credit score, but for the purposes of you making sure that there's no errors on your credit, I would say that that's a good thing to do, whether you're on the market for a home loan or not, just to make sure that things that are there are reporting correctly. Pre-approval is going to consist of the lender gathering information from that consumer. So what information do we need? In every application, we take a look at it at a 2-year snapshot. So we're going to take a look at your 2 years of residence history where you've lived, so that's addresses and all of that good stuff, and a 2-year employment history. So if you've been at your job for less than 2 years, we'll need to document what your 2-year employment history looks like. For all of you who are perhaps, you know, viewing that might be recent college graduates, you know, you spent 5 years, 4 years in college, and now you're working in your career field. Don't worry. Don't think that you're not able to purchase a home until you've been working for 2 years. That's just not true. You know, if you're in a full-time job and you are in your career field that you did your degree coursework in, your transfer is part of your 2-year employment history. So with the pre-approval, the lender gathers that 2-year information. They're going to get permission to pull a credit report. We're going to pull a credit report, and we're going to take a look at where credit is. We're going to validate the information that you give us by asking you to send us some documentation. What does that documentation consist of? Typically, it's 2 years of your W-2s, pay stubs that come at us for the last 30 days or 1 month. We'll ask you for 2 months bank statements, typically a copy of your driver's license. In any instances where there's, you know, income that involves things like retirement income from Social Security, pensions, any military pensions, any, you know, whether it's child support or alimony, like all of those other incomes, if you will. We just have to validate that with the documentation that allows us to see that there's a continuity of that income for the next 3 years. If for any reason we lack the continuity of income for 3 years, then unfortunately those agencies that I mentioned to you earlier, like Fannie Mae and Freddie Mac and HUD, they won't allow us to consider that income as qualifying income. Once we've processed that information, we've validated the findings, we run that loan through an automated underwriting system. We're going to get a green light in that system. Hey, guess what? Great news. Pre-approved for a home loan. Okay. Now we have the fun part. You get to go out with Chuck, get to hang out, see some really cool houses, get to put a couple offers in, get to negotiate one. Once we get a contract that's completely, that's accepted, right? Then that comes back to us, and then we really get started on the processing of the mortgage application.
The next question I have for you, because I get this all the time as a realtor, you know, maybe someone is 3 months out from wanting to purchase a home, or maybe they're 6 months away, and they don't want to get that pre-approval because they feel that it is going to hurt their credit score, and they don't want to have their credit score dinged if they're eventually going to want to, you know, apply for a mortgage and get the best interest rate. They want the highest credit score. So what do you say to those people out there who are afraid that the pre-approval process is going to hurt their credit score? How long does a pre-approval typically last? And can it be renewed if it does expire, if you haven't found a home within that window?
Yeah, that's a great question. And I would say, and again, my personal and professional opinion is if you're thinking about buying a home anytime in the next 6 months, then right at about that, that's not a bad time to make a phone call to a lender and start learning in your market who's there, who's available, who you like, ask some questions, right? That's going to take a little bit of time. When I pull a credit report, that credit report has a shelf life of 120 days, which means it's good for 4 months. Anything in your loan file as far as documentation that I referenced earlier, all of those have expiration dates, if you will, right? Your W-2s are good for a full year. Your bank statements are good through the next month. Your pay stubs are good until the next one that you get. But we have to have pay stubs within the last 30 days. So in the most cases, that credit report timeline is what drives my guidance to consumers as to when they should start. If you are clear in understanding what your credit history looks like, you don't have any doubts or concerns about your credit, then realistically, I would say that you're good to start that process right at that 4-month mark. More than likely, based on the fluidity of the real estate market that we're in at the moment, you're going to start and finish the process within that time frame. It takes us on average at HomeSpire, on a purchase transaction, we're able to close those loans, within 30 days. A lot of times within less time than that, as you know, Chuck. So it's not so much the thought that, oh, I've heard the mortgage process takes forever. It really doesn't, folks. And if your lender is telling you that it does, talk to somebody else, because there's a ton of opportunity right now. Interest rates are super low. Everybody's either buying or refinancing. Lenders that are smart are really taking care of the purchase market because those contracts have closing dates. And no, 60 days is not acceptable. 45 days is marginal. 30 days is where really it's at.
For sure.
So that's to help you determine how quickly you should engage in the seriousness of, right, the action. But one thing that you mentioned that I do want to speak to, and that was, folks are, a lot of people think that if they pull their credit, it's going to ding their score, and oh my gosh, I'm not going to qualify for the best credit. You guys understand, ladies and gentlemen, that first off, myself or someone in my capacity, if you're serious about buying a house and you're not paying cash, and you're going to finance, at some point in time, we're going to have to pull your credit. And you are expected to shop for a mortgage when it comes time to buying a house. It's encouraged that you talk to more than one source for your money. So understand that in the same month, if you initiate a mortgage application with, let's say, Bank of America, Chase, whoever your favorite bank is, the same week you talk to someone who's in my capacity, or you talk to a mortgage broker, please understand that because it's the same application for credit inquiry, which is mortgage financing, there is no adverse impact to your credit score. On average, we might see a credit score drop for that mortgage inquiry anywhere from 3 to 7 points. And that's the first entity that we're pulling. So here we are approaching a new year in the month of January. If lender A checks your credit on the 5th of January, that's the one that's going to drop your score, because if another lender B checks your credit on the 7th, lender C checks your credit on the 10th, everybody's going to see the same score that lender A saw. That way, the consumer is able to truly get an apples to apples comparison on shopping their mortgage, because there is no variance made to the credit scores in that same month. Where it changes is if on Monday, you put in an application for a home loan, but then on Wednesday, you really want to try to get that new car. And well, Saturday you happen to be at Macy's and you're trying to save 10% on that Christmas purchase. Those are 3 different inquiries on your credit. Expect to have 3 different impacts on your credit score.
All right. Thank you, John, for that. So kind of moving away from the pre-approval process, you've given us a lot of information regarding to that. A lot of people hear about different loan programs, and you've alluded to them earlier in this interview: FHA, conventional, VA, USDA. Maybe you could talk about, a few of the more common loan programs and some of the key differences between the different programs.
Sure. I would say, well, let's just kind of start at, let's just do this in the range of the percentage of financing or the percentage of the down payment required by the buyer.
Sure.
So let's start with VA. And to all you veterans out there, thank you for your service. It is an honor to help you along your path to home ownership. You know, VA loans are an awesome loan product. It's a great benefit to have. You know, I've got tons of men and women who have served our country, and that is a benefit that they receive. With the VA home loan, it finances 100% of the purchase, so there's zero down payment. Now, for all intents and purposes, let's be clear, 100% of the purchase means 100% of the sales price. The financing for any mortgage loan, yeah, we don't ever have an option to where we can say, oh, you can borrow 103, we used to, you can borrow 103% of the value of the house, right? So you can finance those closing costs. There's a different way to do that. And I'm not going to mention it right now because, well, that's what you want to call Chuck for. I will say that this, with VA, it's zero down payment. And the other benefit to VA is there's zero mortgage insurance. So now that I've mentioned mortgage insurance by definition exists on any mortgage transaction in which the borrower's initial investment is less than 20%. That insurance is insurance that is placed on the loan amount to protect the lender from the borrower's default. So you might say, well, I didn't hear what's in it for me in any of that. What's in it for you, and that is that you're able to move into a house with less than 20%. And the mortgage insurance is there. It's basically just there as a security blanket for the lenders against any defaults that might exist. So with VA, zero down, no mortgage insurance. Next one would be USDA, which USDA is nothing more, and that's right if you're thinking the United States Department of Agriculture, because that's exactly who's insuring those mortgages. Those are called rural housing loans, and we have them here in Florida quite a bit. What's important to know about those loans is it's all contingent upon the location of the property. So more so than the borrower's eligibility, in order to have and successfully qualify for a USDA home loan, the home itself must be located in an eligible area. There's plenty of, there's a search tool out there. If you were to Google USDA eligibility map, you can find, their map that you can plug in any address in the United States, and it's going to tell you if it's an eligible area for USDA financing. USDA allows you to finance 100% of the appraised value. Notice that that's different than 100% of the sales price. It's 100% of the appraised value. So for USDA, what's pretty cool is, let's say you're buying a house, let's say it appraises for an extra $5,000. Let's say you needed help with your settlement charges and the seller wasn't willing to enter that into the negotiations of the contract, and you were going to get a gift from your Aunt Mary or your brother, your mother, your sister, but you kind of didn't want to do that, but you still went that way because you want to buy your house. The house comes in over value. You'll be able to increase your loan amount, leverage a little bit more based on the appraisal, so then you won't have to go to those sources for those additional funds. Those are the two loans in the marketplace today that cover 100% financing. Everything else is going to cost a down payment, or it's going to require an investment of some sort on the borrower's part. And mind you, for all intents and purposes, on any mortgage loan, I just want to say that as far as your upfront expenses or out-of-pocket expenses, if you've got lenders out there, I don't know that there's any in the marketplace, but if anybody's trying to charge you an application fee, if anybody's trying to charge you a credit report fee or any fees up front to get you pre-approved, simply run. It's just not how the marketplace works. The only upfront expense that you will encounter when working with me, when working with a lot of my colleagues that work with other independent mortgage bankers, is when it comes time for you to make your appraisal payment. And the reason for that is very simple. The appraiser is a third party to the transaction. He or she is a licensed professional that is going to go out and appraise the property, and the appraisal is required when we're involved with mortgage financing because the house is the collateral to the loan. The bank needs to make sure, the lender needs to make sure that the house is worth what it's being sold for on paper. So the appraiser is an independent person. They get paid when they do their work. So hence why you pay for them up front. So we've talked about VA, we've talked about USDA. We took a little left turn there and spoke about a little appraisal real quick. Let me bring it back in. You've got FHA financing, which in my opinion, in my 23-year career, it is the predominant loan for first-time and repeat home buyers, primarily because it allows you the ability to finance up to 96.5% of the sales price. It requires 3.5% down payment, probably the most flexible when it comes to credit criteria, certainly the most flexible when it comes to stretching your income dollars to help you afford, stretching just to afford the most home. And it's insured, by the government. So if you run into troubles down the road, you've got some federal outreach programs that will help you avoid, any foreclosures. The downstroke to FHA is, let's go back to that term, mortgage insurance. Currently, because it wasn't always this way, but currently, FHA home loans require mortgage insurance, and the mortgage insurance on that loan is permanent, which means that whatever happens in time, you pay down the loan to where you owe 50% of what you borrowed, you have the house appraised for a significantly larger amount, and the anticipation or the expectation was, because it was that way before, is that the mortgage insurance will cancel at that time. That's not the way it works today. It's not. It's just not how it is today. With FHA loans, it's permanent. And so that's, I would say, the only consideration. But in that same breath, since it's the predominant loan for first-time home buyers or repeat home buyers, I will share this for the audience listening. Regardless of what that mortgage insurance payment is, understand that when you rent, you're paying 100% interest rate on the rent because you get zero in return for your monthly payment on the rent. Your landlord makes the equity that you don't. So the last time I checked, if an interest rate available in the marketplace, and let's just say it's 3%, and let's just say that with the mortgage insurance, you blend that rate and it becomes 3 1/8%. That's still a heck of a lot less than 100, okay? Plus it's your house. Let's talk about conventional loans, okay? Conventional loans, everybody hears about them, everybody knows about them. Pretty much, hey, if you're putting 5% down, if you're putting 20% down, if you're putting 30% down, chances are we're talking about a conventional loan, okay? Conventional loans have, it's called private mortgage insurance. And what's interesting about conventional financing is the fact that your credit score drives the bus on a lot of the factors that occur with conventional financing. Because your mortgage insurance, it's priced against what your credit score is. Your interest rate, it's also priced against what your credit score is. And so unlike FHA, which is more so, if you qualify for FHA, you qualify for FHA. Yeah, there's a little bit of variances, but the factors don't change when it comes to mortgage insurance. With conventional financing, it does. And the terminology there is called risk-based pricing. If you ever go out there and look that up, that's what you'll find. It's basically just a sliding scale that is based on the bucket of credit scores that are created. Whichever one you fall into is what you can expect to pay for your mortgage money.
All right. So, obviously a lot of differences between the 4 loan programs that John just talked about, including something that is always good to keep in mind is obviously the minimum down payment amounts, knowing how much to budget for when you're looking for your home. But John, next question. In addition to the down payment, obviously there's going to be closing costs and something called reserve funds that I know people in the mortgage industry look at. What do closing costs consist of? What is an escrow account and what are reserve funds?
Yeah, sure. So let's go. Reserves, in essence, is what we call the money that the borrower has left over in their accounts after we total what they need to close on the property. So numerically speaking, let's say that we're buying a house for $300,000 or $250,000, and we've got a down payment that's in that mix, and we also have settlement charges or closing costs, which I'll get into in just a second. And for the sake of an example, let's say that totals $20,000. So the lender needs to verify that the borrower has $20,000 total funds, whether they've already paid a part of that money up on the deposit, et cetera. We need to verify that money exists. And if the loan program calls for it, then the reserves typically, account for 1 to 2 to up to 6 months of mortgage payments. So mortgage payments will be totaled. If your mortgage payments are $1,200, let's say you need to have 2 months of reserves, that would be $2,400. So in the example of you needing $20,000 to buy a home and you need 2 months of reserves, the lender would need to verify that you have total deposit accounts that total $22,400 in that example. It isn't a set standard. It really, what I have found is that is going to be more contingent depending on the individual borrower. Everybody's situation is unique. And so if your credit scores are a little lower, because a loan is a risk and all we're doing is mitigating risk, understand that to the lender, someone that has some additional cash reserves, money in the bank left over after their purchase is a little bit more secure. Less risk because we see that they have the ability to make that first payment. With regards to closing costs, there's a lot of different things that go into that. So because we have things like a title company or a closing attorney involved, you have your lender involved, you have homeowners insurance involved, it is a sales transaction. So believe it or not, you close on a house, you're paying sales tax to the state of Florida. And so you might have a homeowners association where you're purchasing a home, and they may have startup costs that are in their bylaws for anybody who purchases a home in the community. You have to make a capital contribution. And so in all of those closing costs, typically you're going to find that there's a lot of little numbers that add up to, one big hairy, scary number. Also know though that in closing costs, it's a negotiable point. Right? I mean, how many times, Chuck, haven't you negotiated contracts for your clients where the seller's covering all of their closing costs, and pretty much all they have to worry about is their down payment. We worked with a couple of veterans before that they bought their house with 0 out-of-pocket total because we were able to, you were able to work hard for them and get those covered for them. A lot of times also based on where interest rates are today, the interest rate that you're quoted, that might come with a lender credit. So that's another way where, we're able to help, if you will, folks lessen their out-of-pocket expenses. Last question that you asked me was with regards to an escrow account. And an escrow account is in essence, it goes with your mortgage. So if you're a first-time home buyer, or if you're putting down less than 20% on a home loan, the lender is going to require that the monthly payments that are comprised of whatever the annual totals are for homeowners insurance and the annual property taxes, those go into your monthly payment. And your qualifying payment is why you've heard the term principal, interest, taxes, insurance, and any mortgage insurance or homeowners association dues. That's what determines your qualifying payment. Homeowners association is never included in your monthly recurring mortgage statement. You always pay those dues directly to the association at whatever the frequency they bill. But principal, interest, taxes, insurance, and mortgage insurance, yes, those are all factored into your monthly payment. Your estimated monthly payment will include those totals, and then the lender every month, they separate out of that payment what goes to principal, what goes to interest, and then what goes into the escrow account is the reserves for taxes and insurance. That way, in Florida, we pay real estate taxes for the year in November, so we kind of pay them in arrears, right? So in November, right before Turkey Day, you don't have to pop out of pocket with several thousands of dollars to renew your property taxes, to pay your property tax bill. Your homeowner's insurance, it's renewed on the anniversary date of which you purchased your home. A lot of times that's December, it could be in the summer. So instead of you having to fork out thousands of dollars at different times of the year, it's all in one monthly payment, much easier for budgeting, and you don't have to worry about where you're going to get the money to pay your property taxes because it's already taken care of.
All right, sounds good. So just to touch on and to kind of reiterate, so the reserve funds, and obviously you need to show a certain amount of assets, within your bank accounts in order to be, approved for the mortgage loan. In regards to that, how long does the money have to be sitting in the bank accounts or whatever accounts that you have your assets in? And how is that affected by, let's say, gift funds or funds that someone has given you to help you purchase a home?
Sure. So The reason that lenders ask for 2 months bank statements and not 5 months bank statements or 1 month bank statements is because the agencies have determined that we need to verify that the borrower has had the funds that they're going to need to purchase their home on deposit for 60 days. And so oftentimes you may not have that money in your account today because you are going to pull it from your 401k, or because you know that you're going to be getting a gift from one of your parents or relatives. And so the biggest advice that I can give anyone who is, in that position of we want to buy a house and we know that we don't have the money in the bank right now, but we know that we can get it. Before you start to just arbitrarily move money around, talk to your lender. We can really tell you just how easy and simple it is to document funds that you need to purchase your home. Whereas if you just start to make deposits into your bank accounts, please understand that all you're doing is creating extra homework for yourself. Any non-payroll deposits that an underwriter will see on a bank statement, usually, depending on the dollar amount that it is going to require documentation and explanation. So if let's just say that you go out and you need $5,000, instead of just saying to your lender, hey, I'm getting it for my brother, it's a gift, in which case then we have a gift letter that's used standard in the industry that we will prepare and send out, and ask your brother to provide, the evidence of where he was able to document where he has the money from. If you just put $1,000 in your bank account as a counter deposit for the next 5 weeks, we may not be able to use that $5,000 because cash is untraceable. Unfortunately, cash is king in the world, but cash is a dirty word in my industry because we can't track it, we can't trace it, we don't see where it comes from.
Sure.
So again, have that conversation early with your lender. Let them know at the time of pre-approval what your intentions are with where you're getting your funds, and trust in the fact that they're going to give you the right guidance.
All right. Good stuff, John. All right. So moving past, again, the pre-approval process, you've gone out, you've gone home shopping, you found the home of your dreams, you have it under contract, and you're ready to actually start the mortgage process. What does that look like, John? What are some of the things, what kind of documents are going to be required up front from a consumer, from a lending standpoint?
So we're going to ask for the most recent pay stubs that cover 30 days. We're going to ask for the most recent bank statements. We're going to ask for all pages to those bank statements, even if page 7 of 7 is blank. We're going to ask for a copy of your driver's license. We're going to ask you for your last 2 years tax returns, your W-2s for the last 2 years. If you own a business, or if you have any side businesses, or anything outside of just regular, employment where you get paid with a W-2, we're going to need those tax returns because we're going to need to average out your income. If you've ever been, married and unfortunately been divorced, and there's any obligations that you have related to that, then, underwriter's going to ask us for a copy of your divorce decree. If you are in the military, retired military, you receive military pensions, you receive Social Security income, you receive pensions from any place you've retired, a pension award letter will be requested to satisfy the inquiry of if it's, a lifetime benefit. And yes, I know, I will tell you this, there's sometimes things that we understand to be common sense. The mortgage industry and obtaining a home loan, it's all about checks and balances. We don't assume anything. We don't take anything for granted. We check and verify everything that we have in that loan file.
All right, fair enough. So, advice, I guess, to anyone out there who's going through the process, if the lender is requesting these documents, it's not because they want to, it's because they have to, right? Based off of the regulations that you guys are living by. So good to be aware. So in regards to getting a good deal, John, and this is where I think there's a lot of I don't know if it's confusion is the right word, but people get intimidated, right? They apply for a mortgage and they get a loan estimate, and there's about 100 million numbers on it, including an interest rate, including an APR percentage. Maybe you can speak to, you know, what's the difference between an interest rate that someone quoted on the loan and what the APR percentage is?
Yeah, that's a great question, actually. So the interest rate is the actual number that you would borrow and pay the money back out, okay? The interest rate is called the note rate. That's the number that you're going to see when you go to close and you sign your promissory note. So that is the number, okay? Now, what happens is that as a lender, not only am I required to provide an itemization that breaks down in dollars and cents line item what the loan is costing the client, but in addition to that, I have to provide a disclosure that tells them what the annual percentage rate is. And it's important to understand that with APR, APR is nothing more than taking the note rate, adding the closing costs. You got to put that and spin it in a blender. And it's going to give us a number. Okay. Your annual percentage rate is always going to be higher than your note rate because you have closing costs that you pay to obtain the credit. If your mortgage carries private mortgage insurance, which is financed into your loan, understand that that's a finance charge. That equals to an increased APR versus a loan that doesn't have mortgage insurance finance. And so keep in mind that you don't pay your closing costs every year for the 30 years that you own the home. You pay your closing costs at the time of closing. So that APR that you see, it's there to represent the cost of the loan in the form of an interest rate to you as the consumer, in addition to providing you an itemization that shows you in dollars and cents what the cost is.
Okay, fair enough. What about origination fees and lender fees? You know, what do origination fees consist of? What is a roundabout number that people should expect? You know, what's a good deal? What's not so good deal look like? Maybe you could speak to that.
Yeah, of course, and it's like every mortgage company, you know, we have administrative costs to produce the loan, and you know, you might find where origination fees are shown on either a loan estimate or closing disclosure. You know, those are all numbers that you're going to receive up front, you know, from your lender, and if you, at least you should receive those numbers up front. That's their cost to do business. They should be happy to show you what that is. And so I'd say on average in our marketplace here in the state of Florida, lender origination fees total, you know, anywhere from $1,500 to $1,700. When we talk about deals, you know, interest rates right now are so good that a lot of times, you know, when a customer locks in their interest rate, they're getting a rate plus a lender credit. You know, anybody who's employed in healthcare right now, you know, because of obviously the situation that we've got going with the pandemic, there's not tons, but there's certain lenders out there that do offer some special discounts where they absorb any lender fees for any of those borrowers that are related to that profession as a thank you, you know, for being on the forefront during this time that we're going through in our country. And so you still have to figure that the cost has to be disclosed. That's operating in good integrity and transparency. When the rate is locked, there might be a lender credit that offsets, you know, whatever that portion of the lender credit where lender charges were. So origination charges exist. If companies that are out there telling you that they don't charge any, the chances are is they're making it up in the form of an interest rate. Let's be real, folks. You know, it's 2020, almost 2021. You know, I've been hearing this since 1976, 8. You know, nothing in life is free. It still applies today. So, you know, if you're not seeing it on the one end, it's probably because it's buried someplace else that you're not seeing it. Ask questions and get clear.
Fair enough. And in regards, kind of going back to interest rates, John, you know, you see a lot of different types of ways to structure a loan. You hear about adjustable rate mortgages, a 30-year fixed loan versus a 15-year fixed rate. You know, maybe you could talk about some of the differences, advantages, and disadvantages of those types of loans.
Sure, that's great. I'd say that in the interest rate environment that we're in right now, the adjustable rate mortgage has lost some of its novelty for the time being. You know, an adjustable rate mortgage is typically going to come in a couple different flavors. It's either, you know, a 5-1 or a 7-1 or a 10-1. That first number, 5, 7, or 10, represents the number of years that the interest rate is fixed. And after that, you'll see that it's a 1, means that the rate can adjust once per year, every year thereafter. Now, that said, every single one of those products, it's an adjustable rate mortgages, there's certain caps, okay, as to how much you can adjust per year and how much can adjust over the life of the loan. That's all information that is provided, to consumers up front. Currently in the marketplace that we're in, the rate environment that we're in, I would say that you would be, remiss to not just go with a 30-year fixed rate loan or a 15-year fixed rate mortgage. When you're looking at a 15-year versus a 30-year, sure, the interest rate might be lower, but also understand that you're compounding the term to repay back that money in half, which means that your monthly payment is going to be higher when, comparatively speaking, looking at a 15-year or a 30-year loan. And so it really comes down to two things, in my opinion. A, as the consumer, what's your desire? B, as the lender, what are you qualified for?
All right, fair enough. And in regards to points, John, I hear about people saying, oh, if you can buy down the interest rate, you purchase points on a loan to make the interest rate more favorable. Maybe you can explain what that means, for the people watching this video.
Sure. Yeah, discount points, in essence, it's an amount of money. So interest rates move in fractions of 1/8 of 1%, so 0.125. And discount points are paid, in essence, in the same manner. That said, when someone is talking about discount points, you're in essence, you're looking at whatever the market rate that's offered that typically doesn't cost anything. If you're looking to obtain an interest rate that's a little bit lower, or if you need to, and again, it could be 1/8 of a point lower, it could be a whole percentage point lower. There's going to be a cost associated with that, and that is called discount. So by definition, a discount fee is monies that's paid in advance to offset the margin that the lender would have on a different interest rate, so that the consumer can still obtain a lower interest rate, and obviously the lender is still netting out their same margin.
Okay. Fair enough. So we've talked about the pre-approval process. We've talked about, the actual mortgage application process, what kind of documents you're going to be expected to furnish. We've talked about some of the different loan programs, how they can be structured. So John, what do you expect from here? Let's say you're moving along in the loan and you go to the appraisal process, which you have alluded to previously in this video. How does the appraisal process affect from a lending standpoint? How does that affect the loan?
Sure. And so realistically, the appraisal is like I said, that's the due diligence that's performed during the loan application process. That report will provide the lender with a valuation or a value given to the home. It's an opinion by a licensed state certified residential appraisal. So appraisals, like I said, it is an opinion. It is not a science. If you put 3 appraisers on the same house, you're going to get 3 different numbers. 2 of them will be similar and 1 will be off. And it's just how it works. We are all unique and individual in our own ways and unique. An appraiser's opinion of a property, they do have to use data. And typically that data that's going to be pulled are homes of similar size, characteristics, locations, etc., within a 3-mile radius that have sold in the last 90 days. In the absence of that data, an appraiser is able to go outside of those guidelines, in which case, when we get the report, we're going to see that the report gives us the subject property. This would be the house you're purchasing. And then they compare it to typically up to 6 different homes in that area that we mentioned, 3 miles out, that have closed within the last 90 days. A lot of times an appraiser is going to include another active listing in there to support their opinion. And so most appraisers, there's a term called bracketing the sales price. Bracketing the sales price. That means that the appraiser, typically, for them to know that the work that they're doing on that report is accurate and correct, and isn't going to have, a reject or pushback from Fannie Mae or Freddie Mac. They're always going to look, once they have formed their opinion of what that house is worth, they're going to see if there's not something else that is sold, perhaps a little bit higher, okay? Even if it's maybe it got an extra bedroom, or maybe it has a different, that one has a lake view versus this one does not. It still identifies another home that is sold at a higher price point in the immediate vicinity that would be a close comparable to it. That way they're able to, in essence, then provide the opinion of value for the home that you may be purchasing. Sometimes if they can't bracket that sales price, and they have to write and do a little bit more work, if you will, in their report to justify why they may have the highest value for the area.
Okay, fair enough. So provided, John, that the loan goes through the appraisal process and the transaction is going to move forward, what to expect from there? How close are you then to getting the three words we love to hear in the real estate industry, the clear to close? Is that the week before closing? Is that the day of? Is it the day before? In your experience, when do you get that green light, like you're good, everything is going to happen?
Sure. And so, well, it's because of the fact that you have a borrower, right? And everything, if you were to look at, like a file folder, you've got two sides. On the one side is property, so the collateral. So appraisal, title work, anything related to the actual property itself goes on one side. And then everything related to the borrower goes on the other side. We underwrite the borrower up front, so we have this piece taken care of, right? We just need to worry about that collateral piece, which is then when we get that contract, then we have the appraisal come in, then we have title come in. We put all of that together, right? And our underwriting department will then review and complete their assessment based on what's in the guidelines to ensure that we have everything we need to meet requirements. That's when we'll obtain that final approval and clear to close. It's important, to hit on appraisals because it's something that I'm seeing right now in the marketplace, and it's something that I think it's important to get out. Two things. Number one, because there's such a demand for housing right now, and because there is not just high demand, but really high demand, there's a lot of bidding over asking going on with offers right now. So bidding over asking simply means that you're making a bid or an offer above the asking price on the house. Understand that just because you make that bid or that offer, that's how you negotiate to accept the contract. That has zero carryover and implications into what an appraiser thinks the value of the house is. And I share that simply because your mortgage amount, the actual amount of money that a lender will allow you to borrow, it's going to be contingent upon the contract sales price or the appraised value, the lower of those two. In the example where you have a contract price of $500,000, you have an appraisal that comes in at $490,000. Your loan, in essence, if you were borrowing, let's say 90% of 500, which would be 450. I'm sorry, maybe I didn't get that right. 9 times 4 is 360. Get it straight one day. I've only had one cup of coffee and it's only Sunday afternoon. Nevertheless, sales price comes in $10,000 less. The loan amount will be adjusted downward based on that decrease. So that means that you need to cover the difference on what you're bringing to the closing simply because the house did not appraise. It also offers you the ability, and this is one thing that, Chuck can certainly help out with, is to work on negotiating with the seller so that they bring down their list price to match what the house appraises for. In all reality, understand this, ladies and gentlemen, when a house goes on for sale, there's typically an agent, like Chuck. They're going to give the seller a report based on the data that's out there. Sadly, unlike Chuck, there are some professionals out there that are going to inflate the number that they feel they can sell the house for. And it's just simply a means for them to get the business from the seller. Nevertheless, a real estate listing agent, a real estate sales agent, understand the title doesn't include appraiser. So, they're going to use the data that they have available to them to provide you with the best estimate of what the value of the home should be. Ultimately, an appraiser is specialty. He or she specializes in values. So that's what, the purpose of having that appraisal is for. Don't want to scare anybody away. Just want to have that clear conversation so that we have right expectations moving forward.
Awesome. All right. So you've closed on the loan. Everyone's happy, right? You get the keys to your
Celebrate.
brand new home. From a lending standpoint, when can you expect to make that first mortgage payment?
Yeah, that's a great question. Actually, so we would close. Let's just say, so we're in it's December 2020. We've got a lot of closings that are coming up here, this next week, before the end of the month, before the end of the year. If you close in the month of December, you will not make a mortgage payment on January 1st. You will make your first mortgage payment on February 1st. Your mortgage payment will be due on the 1st each month, and you have a grace period up until the 15th before your mortgage payment is late. If you pay your mortgage payment on the 16th or any other day that month, and make sure that you pay it that month, you don't want to be late, then you will incur a fee. Typically, it's 4% of the payment amount as a late fee for making that late payment. So again, whatever month of the year you close in, you're going to skip the next month. Your first payment starts the month after.
Right. And realistically, with the 15-month, and not to encourage this, but you do have a 15-day grace period. So realistically, if you get in your scenario, by February 14th, you're still kind of good.
You're still good.
Okay. That's good. That's good stuff for people out there who are renting. Rent is paid in advance, right? So, January's rent is due January 1st for the month of January. It's kind of the opposite when you're paying your mortgage. That February 1st mortgage payment is for the previous month's mortgage, so that it's paid in arrears. So there's a lot of different ways, talking about saving and budgeting for buying a home, that you can essentially skip a month or at least part of a month housing payment because of the way mortgage payments are set up. And that's really the reason why I asked that question of John, just to make everyone out there aware. So as far as, you mentioned the escrow account and the mortgage payment, as far as taxes and homeowners insurance, is that paid separately? Is that all included? How does that work?
So on the day of closing, the numbers the final figure that is brought to the closing table to complete the transaction, that includes all of it. So that includes any proration for property taxes, that includes your first year's homeowners insurance premium, and any reserves that would need to go into your escrow account. That is the final accounting that's done on the purchase. And we've mentioned closing costs earlier in our conversation. Understand that inside of those closing costs is a section called prepaid items, and those prepaid items are the interim interest that's paid on the loan from the date of closing until that end of that month. It includes the first year's homeowners insurance premium, the full amount collected. It will also include any reserves for those corresponding number of months for insurance and tax payments that goes into the escrow account. And the purpose of that simply is, keep in mind, if we were to close on a house in December, we're not going to make our first payment until February, assuming that our taxes for property taxes are due in November. From February until November, we don't have 12 months, correct? So at closing, we have to deposit, the customer has to deposit enough months of reserves in advance so that when you start making that February payment, by the time we get to November, you've got 12 months collected for taxes. The tax bill will be paid in full by your lender. That same math or that same theory applies for the homeowner's insurance.
Okay. Good to know. And then last question before we kind of wrap things up. As far as, saving money over time, is it true that people can save money on interest and potentially reduce the term that they have to pay their mortgage if they make extra payments towards the principal balance over time?
So absolutely, the answer to that question is yes. The sooner that you pay off your mortgage, the more quickly you accelerate payments on the mortgage, the shorter the term or the time that you have that loan outstanding will be. That said, I hear clients that call me and they ask me questions about biweekly payments. And I'm all for that as long as it doesn't cost you any money to get that set up. Understand that if you were to look at a loan or a biweekly, payment schedule, because there's 12 months in the year, right? I think biweekly it turns out to be 26 pay periods in the year. So simple math, guys, is just that's 13 months. You could write one extra check during the course of the year to the mortgage company. In the memo, I'd suggest you put principal only, pay it for the amount that you want to pay in, and you get the same net effect than you are banking those biweekly payments.
Simple enough. All right, so that kind of wraps up a lot of the specific questions that I have for you, John. And John, I thank you so much for coming on here. I mean, you're just you're spitting knowledge all over the place. So thank you so much. I know we've covered a lot, with this interview, from how to select the right, excuse me, lender for you, to the pre-qualification or pre-approval process, all the way into the actual mortgage underwriting process, to the appraisal, A to Z. I think we've covered pretty much everything. And again, thank you, John, because I'm grilling you pretty hard and you have amazing answers to everything I'm coming up with. But just one last question, before I let you go. If you are again looking into the camera here, and everyone out there watching this video looking for education on lending and the real estate transaction process, if you were to give them one piece of advice to help them in regards to lending, what would that advice be?
Well, if I was giving anybody a piece of advice who's listening or watching this today, I would say highly, is for them, they would make it a huge mistake to not reach out to you and have a consultation. Outside of that, I would say that real estate is a great investment. There's a great sense of pride. There's a great sense of achievement. A home it's a big deal. I bought my first house when I was 25, and I still own that house today. The memories that I've created, the fun that I've had, the paths that life has taken me through, and yet I still have that house. And so it is with you. Your life will always constantly change and evolve, right? We know that for sure. But a house gives you such a sense of feeling like you have foundation, you have your place, you can do things. You don't have to worry about asking permission from a landlord. You have the freedom that really comes with, the liberties that are given to us by being in this great country of ours. It would be foolish, in my opinion, for anyone to not consider the opportunity that we have present, right? Windows of opportunities open and close without notice. We have never in the course of our history, had borrowing costs as low as what we have today. And when you consider that, median rent for a house in the Central Florida area is about $1,500 a month, and that doesn't get you any of the nice new shiny apartments that you see being built. Those are all starting around $1,800 for a studio and $2,300 for like the 2 or 3 bedrooms. Gosh, you would be making such a grave error, financially speaking, in my opinion, to limit yourself to renting and not giving yourself the opportunity to at least learn what you would need to do if you can't immediately engage in the home buying process, what you would need to do. Folks, I've been in this industry for 23 years. I can tell you that I have clients who've called me that I've talked to, a year ago, and they did their homework assignment. Whatever I've suggested, they took care of what they had to do, and I was able to deliver, on successfully helping them close on their home. That can be you too. There's nothing that is bigger than your will. So don't allow your circumstances to ever be greater than your will and your desire to choose and to follow through on your goal, specifically when it applies to homeownership.
Well said. All right, John. I greatly appreciate you coming on. My name is Chuck Burt. I'm a realtor here in Central Florida. This is John Edmead with Homespire Mortgage. If anyone has any questions in regards to what we covered throughout this video, please feel free to contact myself. Call, text, email, whichever method you prefer, or contact John in regards to his services. We appreciate everyone out there, watching this video. We hope you learned something today. Thank you so much. And again, thank you, John, for coming on. This has really been great. Thank you so much.
Thanks for the opportunity, Chuck. It's a pleasure being on here with you. Have a great afternoon.
Take care, John.
Be well.
Bye-bye.